All right, so let's begin the show, and we will begin the show with our segment, Meet Your Fund Manager. And the fund category in focus today is multi-asset allocation. And here I'm talking about DSP Multiasset Fund today, for which today I have with me Aparna Karnik, SVP and Fund Manager, DSP Mutual Fund. Aparna, good evening and welcome to the show. And we'll be deep diving into the fund's nitty-gritties. But then before that, let's talk about the category and the kind of return in this entire year we've seen from the category. I guess your fund also was launched somewhere in September. So just going back, what was the need for you to come up, your AMC to come up with this kind of a category?
So basically, this is the first fund which we have, and the only fund which is a multi-asset allocation fund where you can invest in across all asset classes, including domestic equities, global equities, fixed income, and also commodities. So we don't have any fund which can invest across all these four asset classes and in a fairly unconstrained manner. So for us, this is a first of its kind.
Now, talking about the category, what is so beautiful about multi-asset allocation funds that you think has worked for this entire year? And why is it the right time to have this kind of a category in your portfolio?
So what's the beauty about multi-asset allocation funds in general is that, different asset classes perform different functions. So you have basically equities for growth. You have fixed income for income during times of deflation and recession. You have precious metals and commodities which protect you against inflation and like currency depreciation. And you also have hedges, tail hedges, which protect you in event risks such as, say, COVID or some kind of a geopolitical risks. And there is a need for all these asset classes in the portfolio because, while right now we may be in a very strong positive growth phase, but we've seen in the past, markets, economies, investor behavior also moves in cycles. So when you have all these asset classes in the portfolio together, you can actually navigate these cycles much more smoothly. And both the investor can have a very good experience and ultimately meet their objective of long-term wealth creation and protecting their purchasing power. So it's a fund for all seasons, so to speak.
Let's talk about DSP MAF, which is Multi-Asset Allocation Fund in short form. Okay, the kind of exposure you have in the fund is across asset classes. Is you have equities, domestic as well as international stocks. You are in debt instruments. You have gold ETF and commodities, and you also have exchange traded commodities derivatives. Could you explain or elaborate more on the asset allocation?
Yeah, so right now we have about 55% of our fund in equities, of which a bulk of it, 40%, is in domestic equities across sectors and across market cap. So large cap, mid cap, small cap. So like any flexi cap fund, about 15% we have in global equities, and that is mixed across. Some of it is we've taken the exposures through ETFs, where we saw very strong secular tailwinds and very attractive valuations for some of the sectors, global sectors. So that's about 55%. We have about 17-18% in precious metals, largely in gold via our gold ETF, and some of it in silver. And the rest of it is in fixed income, at this point. So across sovereigns, and across corporate bonds. That's the kind of asset allocation we have right now. We keep reviewing our asset allocation. I mean, there are obviously different factors playing a role for different assets. So we look at things like valuations. We look at things like earnings growth forecasts. We look at things, we look at global macro data points, etc. And we review our asset allocation on a monthly basis, and we change it as required. But what I would like to emphasize is that the fund is a true to label fund, and it has meaningful allocation to all the asset classes. And in addition, we even, to cover sort of tail events which nobody can predict, we even have hedges such as, Nifty put options, etc., which we buy whenever they happen to be, again, attractively valued. So that's how the portfolio construct works like.
Let's talk about the 40% domestic equity allocation. Over here is thrust given on mid cap and small cap. How, as per market caps, you are diversified in domestic equities?
Yeah, so we actually don't have a predominant part of the portfolio in mid and small. We have most of a large part of the portfolio of this 40% is invested in large caps, where we see good growth tailwinds, strong managements, and valuation comfort. So of this, about 25-30% would be in large cap private sector banks. We also have some large cap names in the pharma and IT sector, as well as, in space like auto. So we have a fairly diversified portfolio. We have some select mid and small caps across, again, pharma, auto, ancillaries, some of the spaces where we found, interesting opportunities, both in terms of sort of long-term secular tailwinds, good companies, attractive valuations. And we have selectively added that exposure, but it's still got a lot of large caps in it, which are more liquid and where there's a lot of comfort at this time.
Apart from that, your allocation in debt instruments is comparatively less, right, as compared to commodities?
No, we have about like 25% allocated to fixed income, so it's fairly material at this point. We have exposure across, the corporate bond space as well as sovereign securities.
Let's talk about volatility. Now, since we are talking about a multi-asset category, and the basic nature is to also divide the risk involved in each asset class. If at all you have all your eggs in one basket, here you get to diversify. So yes. Talking about the realized volatility each asset class has, and your strategy in order to reduce, or maybe the correlation. The lower the correlation among asset classes, the better it is for you in terms of risk and volatility. So how would you like to explain this aspect given your fund exposure?
Yeah, that's true. So in case of sort of reducing risk via multi-asset classes, it's like a 1 + 1 is not 2, it becomes 3. Because essentially when you pair an asset class with another asset class which behaves contrarian, that meaningfully reduces the volatility of the portfolio. And for example, we look at, say, equities and gold. So equities have almost 0 to negative correlation with gold, which means when equities are doing badly, gold tends to do better. And by sort of having this kind of a blend of asset classes which tend to behave opposite to each other. So for example, if you have hedges, they behave directly negative, almost a full 100% negative correlation with equity. So by blending the asset classes, the portfolio volatility reduces quite dramatically. So in fact, our historical sort of understanding and our historical experience shows that having a meaningful mix of non-equity asset class like commodities, etc., can actually reduce the volatility by more than half the equity volatility. So if, for example, you have a certain volatility associated with equity, we understand that having this kind of a blend can reduce it by more than half without materially impacting the returns, and so that's really, the alchemy of, multi-asset allocation. And one of the, very well understood reasons, I think investors also understand this aspect fairly well. And, and that's one of the beauty of the design of this type of fund structure.
Aparna, now going ahead, the kind of scenarios we are seeing, like for example, if you talk about Fed, there has been news that we might see a rate cut beginning from next year, early on, maybe March or so, depending on the data. Now, keeping all these factors in mind, we just saw the result of our state elections, and we sort of have a picture of where the Lok Sabha election could be tilted. I want to understand now, considering the rate cut or the interest rate scenario globally in India, and looking at the domestic triggers that we have for our markets, would you be willing to increase your exposure in commodities, looking at the kind of run-up we're already seeing in golds right now?
So in fact, we have increased it since the fund launch, which was in September end. So if you see our portfolios over September and October, which are in the public domain, you will notice that we have actually ramped up the exposure to precious metals and commodities.
You don't have crude oil, right, in your commodity portfolio?
We don't directly have exposure to crude oil, but as I know, India is an importer of oil, and hence one of the tail risks that we seek to protect the portfolio is, a very sharp spike in oil prices, which could happen maybe because of any unforeseen geopolitical risk. So instead of directly buying oil commodities, we have exposure via ETF, which invests in global oil exploration and production companies, such as it's there in the portfolio in the form of an ETF, investing in global oil exploration and production companies, about a 2.5-3% weight. You can see the most recent fact sheet. So that's how we took the exposure. So we have it, but not in a direct commodity form, via commodity equities.
Would you be willing to have one more asset class, or maybe would you want to diversify to some other asset class also, like a REIT, going ahead?
So we are actually open to evaluating all asset classes as permitted, in our offer document. We do evaluate them from time to time, and we will review if we feel that, from returns, from risk, from liquidity, we are seeing something which can give better returns than the mix that we have in the portfolio. We will definitely look to add, at that time. Right now, we don't have any exposure to this, but it's something we are open to take, at the right opportunity.
What should be the fair expectation of return that an investor can have from your fund?
So, I mean, we aspire to, obviously, we cannot give, or we cannot predict also the exact returns, but we aspire to, and looking at historical data, you can say low to mid double-digit type of returns. That's what we aspire to, and that's what the historical data has shown. Of course, this would be something which you can, look forward to over a cycle, and returns can be very different on a year basis, as we all, very well. I mean, there was a year like 2022 where all asset classes, did badly, but it'll be compensated, in other years. So if you look at it over a cycle, we would aspire for, low to mid double-digit growth via mix of asset allocation as well as, some stock selection as well. That's how we would aspire to achieve that type of objective. But again, this is just aspirational. I mean, the returns will obviously not be linear.
What's the tax treatment?
So in this fund, the tax treatment is, so there is a minimum equity of 35%. So basis that, it qualifies for debt plus indexation type of tax treatment. The reason for this is that, we wanted to have freedom and more unconstrained ability to invest across asset classes. So there are funds in this space which, have a higher minimum allocation to equity. But in our case, because, we wanted to have meaningful room to allocate to the other asset classes, therefore, it's just minimum 35% in equities, and therefore it qualifies for the debt plus indexation taxation, which we believe should be a good proposition for any investor willing to remain invested for like 3 years. We don't feel that they will lose out, materially because of the taxation.
All right, I think that will be all. Thank you so much, Aparna, for being on the show and helping our viewers understand the Multi-Asset Allocation Fund by DSP. Thank you so much.
Thank you. Thank you. Good evening.